How's it going, everyone? Welcome to the sweep. We're going to get started here. Just going to leave this up here for just a moment and give you guys an opportunity to read through that. And of course, our social links. All right. Okay, good. All right. Let me check this because I'm getting a notification that it's not. If you guys do have issues with connectivity or you're not hearing things or skipping around, let me know. For whatever reason, I got a notification pop up saying that it's not receiving enough video to maintain smooth streaming. So let me know. I want to make sure that the video comes in clear because we've got a hot topic today. First thing we're going to do first is we're going to cover Forex news. As usual, I didn't update the link, so let me go to Forex Factory and let's check the week news. Okay, I think we're good now. Sorry about that, guys. I'm not sure what's going on with that. We're just getting some connectivity issues. Okay. Still giving me some issues. Hang on one second, guys. I apologize. See if it helps to close some of this stuff down. Okay. We'll try that. Hopefully that holds up. Okay, so Tuesday, we've got a lot of low-impact announcements, August 24th, so not much there. Wednesday, a few medium impact. The euro has some medium impact, German IFO business climate, core durable goods, and crude oil inventories for U.S. dollar. Not too much kicking up dust there. Thursday, we've got prelim GDP for U.S. dollar, 6:30, so keep an eye out for that one. That's 8:30 Eastern. And then Jackson Hole Symposium. This one's going to be a big one, guys. The Jackson Hole Symposium. So Federal Reserve Bank of Kansas, right? So this can cause some, generally they'll be in session and they'll come out and then sometimes they'll, answer questions. And a lot of times it's more than a day. Sometimes it's 2 or 3 days. So we should see this on not only the 26th, but also the 27th. Let's see, Fed chair. Here we go again, day 2, Jackson Hole Symposium. And that's on Friday. And then again on Saturday, Jackson Hole Symposium. So if you guys are in trades on Friday when the market closes, just be aware that, if you stay in those trades over the weekend, you can come back to a different market, especially when they have these types of things like the Jackson Hole Symposium. So keep an eye out for that, because that could cause some ruckus over the weekend when you are helpless. There's nothing you can do about your trades. You can't close them. You can't do anything about them until Sunday when the market opens at 3 o'clock Mountain, 5 o'clock Eastern. So just be aware of that going into next weekend. You guys should be making a habit of checking your announcements every day and not to take trades during the announcements in spite of popular belief. That's a sucker bet. You're better off going to Vegas. It's so that you know when you should be aware and stay out of the market so you don't get caught in something that you're not expecting. Okay, so that's going to wrap it up. We're going to move on from there. So what I want to talk to you guys today about is going to be backtesting. Okay, and we've talked about backtesting before, and I told you it's kind of holding off, and I've decided, I'm not going to hold off anymore. I want to give you guys the goods. So today we're going to talk about the golden ratio analysis backtesting, which is something that my business partner and I had come up with some years ago. So to kind of preface this for you, and then I'll explain the framework, is we didn't really have, when I first started trading specifically, I had never traded before in my life. So I didn't realize that backtesting was a thing, and a lot of the talk around backtesting, and I know some of you guys took up that challenge and went and looked to see what other people were saying about backtesting just in general, right? And when you look at it, a lot of the consensus is you just go back and you practice your setup and see how it's going to work historically. right? But that you've got a predetermined stop loss take profit. You're kind of already assuming you know how to trade it, and now you're just going back to check to see how it's going to work out. But even if you were doing that, there's not really a lot of instruction as to how to check, right? How do you know if your setup is going to work the way you expect for it to work, right? Well, you would have to win. I mean, a clue in is you have to win at a certain win percentage with a risk to reward. Your stop loss and take profit be at a level that is going to be profitable, right? And so when you go back with a preconceived notion, yeah, you can see, okay, yeah, sometimes it wins, sometimes it loses. But if you don't know the ratio in which it wins and loses and what win percentage it has, then you don't even know if it's going to be profitable. Even if it wins 9 out of 10 times, doesn't mean that it's profitable. And we'll talk about that, because I think we're going to have to take this into more than just today. So we may have to wrap this up next week or the following, but I do want to give you guys a framework today. So we didn't have anybody really guiding us in this direction. Now, I do have a market research background, and if you guys know what market research is basically you go in and you call people in a certain demographic, and you want to talk to certain people, depending on what you're doing. Let's say it's for political purposes. Then you talk to people of certain ages. You talk to people, both men and women. You want to get an equal representative sampling. So if there are, I don't know, 1 million voters in a certain area, and they're comprised of 60% women, 40% men between the ages of, let's just say, 35 and 70, then that's your demographic, and you want to make sure you get a representative sampling. You want to talk to enough 25 to 35-year-olds, 36 to 45, and 46 to 55, and 56 plus individuals. You want to get the representative sampling of female to male. You want to get, representative sampling of Republican to Democrat to independent. All these different things, right, that make up that demographic. And then you collect that information and you analyze it, and it gives you an answer. It gives you a result. And with that result, you can make projections, right? They do them all the time with elections, any kind of election. They say, the polls are showing this person is polling really well, or that person is polling really well with this demographic or with that demographic, right? Or all together overall. So those same models, those predictive models, are used with anything that involve a projection, a predictability, right? Traffic patterns, weather, you have farmers' almanacs for farming. I mean, just anything that you're going to create some type of projection, some predictability on, you create a predictive model. And in order to do that, you have to have a representative sampling. So I understood that already coming into this. And considering that we want to risk real money in the market and we want to be as precise as possible, make profit, we don't want to figure out that what we're doing does not make profit after it loses money. Matter of fact, we want to figure out what does make profit before we put real money in the market, right? So backtesting, and I want to preface by saying this, we realized really quickly that backtesting is day trading. And it's actually, for us, it's evolved. Backtesting has evolved quite a bit. We've become more and more and more precise, and we've simplified the process, to the best of our ability. Matter of fact, we now are to the point where we can run backtesting and just provide it to our members, and they don't even have to. A lot of them don't even have to backtest. But there is this byproduct education, this value that you get in actually backtesting and actually doing the work. Because you start to learn how the market ebbs and flows. And if you're working with a specific indicator or indications, you get to see how those kind of ebb and flow and learn more sharply how those work, specifically for us with our indicators. And so we went through this painstaking process of figuring out what is our representative sample, right? What information do we have to include in the data in order for it to be scientifically valuable and plausible, right? Not just, come up with some random things, but actually have things that are going to be representative of what we're doing, right? So we figured those things out, and I'm going to go over with you guys what those things are today and how to collect these things and how far back to go, because all of these things we realized were imperative in being able to create that accurate predictive model that has maybe a 2 to 4% margin of error. That means that if we come back and we say, yes, you can win, based on the backtest data, we could win this trade 75% of the time if we used a 10 pip stop loss and a 10 pip take profit. We can win that trade 75% of the time, right? Now, if I just decided to randomly change one of these numbers and say, well, what if I just did a 5 pip stop loss and a 10 pip take profit? I can no longer assume, unless I backtested that it's going to win at 75%, right? So if I look at this and I say, okay, this is cool, but if I had less in my loss, then I can make more dollars, right? Well, I can't just decide that I want to use this. I have to see if I can find something that would work with it. That this would be a 1-to-2 risk-to-reward ratio, right? I'm risking 1 and my reward is 2. Where this one up here is a 1-to-1 risk-to-reward ratio. I'm risking 1 and my reward is 1. So 10 pip stop loss, 10 pip take profit. My stop loss is equal to my take profit. That's a 1-to-1. My stop loss is half the size of my take profit. That's a 1-to-2. These are called risk to rewards, right? And risk is always first, so that's why that number represents risk. So I don't just get to decide this. I could, but is it going to be profitable? Not likely. It is very, very, very unlikely that it is going to be profitable to just guess what that number should be. And you can't use your perception, because your perception is always going to be skewed and an error of loss or failure or negativity. It's just how our brains work. We can turn on the news right now and they could be, projecting sunshiny days and clear skies and everything's perfect in the world. That's great. Ratings are going to be low. But as soon as there's fires or there's Afghan things going on or there's something happening in the world, believe me, people start to tune in. They watch the news more. It's the negative stuff that we focus on. It's the same thing with day trading. When we look at stuff, we're like, wow, I could have made more movement in that trade. I could have made more money in that. We forget that our process allows for us to consistently make profit over a long period of time. And so our perception in that moment is that we're missing out. Or you see a trade setting up and maybe it's not a trade that you've back tested for and you think it's going to go up and it goes up and you would have won that trade and you think to yourself, man, I should have done that because had I done that, I would have won. But you forget all the other times where you would have lost had you done that, right? Because you're not thinking about those things at that moment. The only time you think about those things is when you should be doing something, right? You think, oh, well, I should take this trade, but I'm not going, I don't feel good about it, and then it loses, like, see, I knew I shouldn't have done it, right? Our brains automatically focus in with this gazelle intensity towards the negative stuff, right? So creating a plan, a blueprint, is the key to a lot of overcoming a lot of the psychological facets of day trading. And so this is why this is so important. And if you're not doing these things, you're not a real day trader and you're not going to be successful at day trading. You have to do these things. This is day trading, right? Or have it done for you, right? But it has to be done. Someone has to do it. And if you do it, you're going to be better for it. You're just going to learn more about day trading. You're going to learn more about your craft and how the market moves and how your indicators, if you're using any, move, or whatever it might be, how the market just kind of ebbs and flows. You're going to get that byproduct education. So there is much more value in doing it yourself than having somebody else do it for you. But in terms of time and effort, energy, frustration, all those things, if that's more valuable for you, then it is wise then, even if it's just for a time, to have somebody else do it for you. And there is an option for that, and it's not always readily available because not everyone puts as much emphasis on backtesting as those of us that are successful at day trading do, right? So you just got to kind of pick, right? Which camp are you on? Are you on the camp that makes profit long-term in the market and becomes successful? Because believe me, we know a lot of day traders and a lot of day traders that don't even trade with our organization. And one thing that is very consistent amongst these day traders that we've met over the years is that they do these things, some form of this, backtesting. So we've created what's called the golden ratio analysis. And so when we created this, we realized that our representative sampling had to be very specific and it had to be inclusive in these factors. First thing is we want to know what parameters must be present when triggering an entry. We needed to know, what does our setup look like, right? We need to pick something that is always going to be consistent. And there's 3 possible answers when we're determining if our setup is present, if that is what we're actually looking at. Yes, it is our setup. No, it is not our setup. or maybe it's our setup. Our yes is yes, our no is obviously no, and our maybe is also no. So you want to be very specific. If it's a maybe, then it's a no. And you have to be very clear in your head as to what your setup is. There's no gray area, because the more consistent it is, the more precise you are with it, then the more successful you'll be with it. Right? And we've talked about this before in other sessions, and that's just mastering one thing, letting it get you rich, and then figuring everything else out. Right? And like that Bruce Lee, and I think I butchered it the one time Bruce Lee said, I don't fear the man that has practiced 10,000 kicks once. I fear the man that has practiced one kick 10,000 times. Right? So it's about mastering one thing, right? Getting really good at it, and then being able to just dominate with that thing. Right? So it's one setup, right, at a time. It doesn't mean that you can't add others later, but just do one at a time. Otherwise, you water down the process. Just master one thing first. You think that you're duplicating your efforts by learning multiple things simultaneously, but all you're doing is learning each of them together at a slower rate. So you'll finish learning all of them at the same amount of time, but if you would have started one at a time, then you would have learned one and then got to a level of expertise and on your way to mastery while you're learning another one, right? But by the time you get to, say, 3 or 4 of them, you're already an expert at one and very close to on your way of being a master at that one, and not having to wait for all of them to come to completion before you can become a master of all of them and then be successful in the market. You can already start being successful with just the one thing and then have time to learn all the other things, right? Okay, so you're very specific as to what your setup is. And then you want to be specific as to the time of day that you're going to be trading. We realized back then that each currency pair, but the market in general, moves differently at different times of the day. And that's very consistent across the board, right? In the, midnight to, say, 5 a.m. Mountain Time, 7 a.m. Eastern, it moves different than it does 8 a.m. or, 10 a.m. Eastern to 10 or 11 a.m. Mountain. And then it moves different from 12 to 5, and it moves different from 6 to midnight or 11, right? So there's those different times that the market just moves differently. We all know, if we've traded at all, that in the afternoon, the market is really slow across the board, right? Bankers are on lunch, and there's just not a lot of movement. Retail traders might be at work or doing other things in the middle of the day. So it's a very slow time in the market. And then we know that in the mornings, there are other times that are more fast-paced. Evenings, there are other times that are more fast-paced. So it just depends, right? So specifically, what time are you available to trade? That's the best time to trade. The best time to trade is not what somebody else says, because that's what's best for them. And maybe it's not even best for them, but somebody else told them that was the best time, and they respected that somebody else enough to say, yep, that's the best time, because somebody that knows better than I do said so. And not really wondering or questioning if it's the best time for them. So what is the best time for you? Well, the best time for you is going to be the time that you have available, whatever that time is. That's how you decide, just like anything else in life, right? If you're going to take a vacation, you plan for it. If you're going to take a break, you plan for it. If you need to get to work by a certain time, then I got to get dressed by this time, and I got to leave myself this time to get to work. And then if you're going to be at work, then you can't do other things that take you away from your responsibility of being at work, right? And you get home and you eat dinner, you hang out with the spouse or the kids, and you do homework or you put them to bed, whatever. Okay, that's time for those things. So when is the time for trading? Well, for some people, it's the time where they sit on their Barker lounger, kick their feet up, turn on Netflix, and binge watch something until they fall asleep. That's the time for trading, right? That's the time to say, I'm going to replace this thing that's not bringing me anything in my life, but just taking from me, which is a liability, and I'm going to turn it into an asset. I'm going to use that time to day trade and better my financial trajectory. That's the time, right? And then maybe that's not 7 p.m. at night. Maybe it's earlier, whatever it might be, but you get the idea. It's a time where you have uninterrupted time to just focus on your craft. So that's the time that you're going to use, and that's the time you're going to test for, only that time, because it's irrelevant what's happening outside of that time and how the market moves outside of that time. It's completely irrelevant, whether it's moving fast or slow or something in between, because you're not trading at those times. You're trading at the time that you're available. That's the best time to trade. Everything else, you'll just feel like a fish out of water, right? And there are other facets here, right? The other is the currency pair. What currency pair you'll be testing first. Now, when you decide what currency pair you want to be testing, there's a couple things that you can use to determine which currency pair to choose. And you're only going to choose one at first, just like your setup. Your setup, a specific time, and one currency pair at a time. Okay, not multiple. Believe me, you're just watering down the process. Do one at a time. So you've got the currency pair, or you've got a bunch of currency pairs, and you're trying to decide which one works best for you. I always recommend demo trading to all of my members and subscribers prior to trading live, and even prior to backtesting. You want to demo trade and just not to try to win at day trading, but just to kind of get a feel for what the market feels like, how to execute in the market, how to set your stop loss and take profit, how to do these things, right? And in doing that, you're going to start to realize that you might be the type of person when the market is moving really fast and you can draw down, go negative really quickly and then maybe come back into positive really quickly, but it's like a roller coaster, that makes you anxious and nervous and is not good for your psychology. Okay, you don't want a fast-moving market, okay, because it makes you anxious. Other people might be anxious if the market is moving too slow and it takes them a really long time to get out of their trade, right? So it's the same symptom but different causes for the symptom. So what is it for you? It's specific to you, not what is cookie cutter for everyone or try to fit yourself into a mold, but form fit day trading to you. You guys have heard me say this numerous times, right? You want to form fit day trading to you, not you to it. Okay, so what currency pair is best for you? Well, if you like a fast-moving market, then you want to pick a currency pair that moves more aggressively at the time that you're available to trade. Okay, so if you're trading in the evenings, then you're probably going to want to use bank or currency pairs where their banks are open, like the Australian or the New Zealand or the Japanese, areas where their days are just getting started while yours is winding down, because then you'll find more activity in those markets. So if you like a fast-moving market, if you like a slower-moving market, then you might want to stay away from some of those and stick with other currency pairs that move slower at that time, right? So you see, you can form fit all this. You can customize this to you specifically, and that's what you should be doing. Realize this early on, and we realize that this is what's most conducive, because there are all these things that stop day traders from being successful. You can look them up. You can go online, and people will tell you, right? Bad money management or no money management, and that's part of backtest. That's the biggest part of backtesting, right? Fear, boredom, greed, all these different psychological facets that stop people from being successful. Well, we've addressed this with backtesting, right? We've addressed it with this framework. These are the specific things we've identified over lots of years, lots of hours in figuring this out with myself, my business partner, and sometimes we even had a team helping us, right? And just allocating, duties. Here, you handle this part, you handle that part. And so it took us a lot of time, thousands of hours, to come up with this golden ratio analysis. And then we tried it out on some people. It worked really well. And then we released it to our membership. And it works very, very effectively and impactfully within our membership, which is why it's one of our foundations, one of our pillars, backtesting, right? So now we've got our currency pair. We know what time of day we're trading, and we know what the setup looks like on that currency pair at that time of day. Okay, so the next thing is we take that and we backtest it from January 2016 to December 2020. This is 5 years, right? Because it's January 16 to December 16, that's 1 year, and then 17 January to 17 December, it's 2 years, 18 January to 18 December, 3 years, 19 January to December, 20 January to December. So that's 5 years. And there's a reason for this. We call these 5 years the proving ground, because it is the ground in which we prove our setup, right? So 5 years. Why 5 years? This is going to blow your socks off, because we realized, and we actually realized this later, But if you go back on, and you guys have seen me do this before, but I'm going to do it again. We go back 5 years, we can see that there are three different, well, we already know there are three different ways the market moves. The market either moves up, down, or sideways. Good, so we need to include that, right? Years where the market moved just up, like when it trends up, right? Or bias, like it did here, all it did was go up, right? And so short-term and long-term trend up, bias just moving in one direction for a long period of time, right? And then bias in the opposite direction for a long period of time, and short-term trends for a long period for a period of time. Consolidation, market moving sideways, short-term, right? Consolidation, long-term, right? And we saw that in order to collect all of these, up, trending, bias, down, trending, bias, consolidation short-term, consolidation long-term, all those things will happen within a 5-year span, 5 to 7 years. There is no coincidence in that it takes the average day trader 5 to 7 years, right? This is not our organization. This is not our membership, but this is what it is for millions of traders around the world. 5 to 7 years to learn how to day trade. And then from that point, 2 to 3 years to become successful. So first they learn how to do it, and then they apply that knowledge and then have exponential growth and success. Okay? So why 5 to 7 years? Well, because they're not back testing, they're just going forward. And they're taking the knocks on the head and then going back to the drawing board, recalculating, going forward, knocks on the head, recalibrating, forward, so on and so forth. So they stay in this cycle right here, right, for 5 to 7 years. And then finally, they've seen every market condition that's existed. And now they're ready to put their plan into action. Now they know how their trade setup works across any market, overall market condition. But instead of going back and looking for those market conditions, they went forward because they're too much of a rush. Well, how did that work out? Not very well. And that's why 90+% of individuals that attempt to day trade in the world, right, fail. Because they can't last 5 to 7 years. And those that do persist, so less than 77%, it takes them 5 to 7 years. So right? Why go and wait for these conditions to occur if they've already occurred? So we backtest, right? And that's why that 5 to 7 year span is part of our representative sampling, right? That's part of the demograph that we want to test for because it is one of the most relevant, okay? And it's a lot. It's a lot to ask, and but if you do it, if you dedicate to it, you can wrap it up and get really good at it and finish a set really quickly, right? Relatively speaking. Okay, so now we've got our setup. So we have the specific condition that the market is the market is doing at a specific time of day for that specific currency pair, tested over all market conditions, right? So do you see how specific this gets? And I'll show you how it gets even more specific than that here in just a moment. And after we're done with that, then we were able to establish our win percentage with the risk reward that is profitable. So we analyze that information. I'll show you how we collect the information, and then we may have to take another session to show you how to analyze it and stuff like that. But we're going to take all of this information, we're going to collect it in a certain way. Okay? So I'm going to show you what that looks like. All right. So let's say that we go back. I want to show you guys because we have a golden ratio template. TPG, okay. All right, let me log in here. Oh, come on. Okay. So let's go to resources. Okay, so right here, backtest template and golden ratio. Obviously, you guys don't have access to this. Now, if you sign up for a Trader Lite, we're going to give you access to this. And that'll download this to your computer. And if you don't have Excel, then you can just copy it, paste it into a Google Doc or whatever, and you collect the date, the pair, and you're only going to work with one pair. So let's just say we're using Euro USD, and then the direction went, buy or sell, long or short, right? And then the time in which it occurred, and then I'll show you what these are. So let's just look at something really quickly. Let's look at dirty pressure setup. Let's find one. So let's say right here, we're testing, let's just say from 12 o'clock to 2 o'clock. So that's the 12 o'clock hour. And then at 1 o'clock, our setup occurs. Okay. So that's the range in which we're testing on the Euro USD, right? So we have our setup. And if you guys don't know what this setup is, dirty pressure, go back to one of the older videos where we talk about the dirty pressure setup. We've talked about it. So you can go back on the sweep videos and watch, and I'll explain to you what this setup is, but I'm not going to do it today. So this is our setup. So let's just say we're back in 2016, and this is our setup, and it's in the time that we're available to trade, right? So if you guys are taking notes, you need to write this stuff down. We have the setup. We know specifically what it looks like, what it doesn't look like. We have the time of day. We have the currency pair, and now we're back to January 2016 to start. And we're going to test every day that the market's open from January 2016 to December 2020. That's right, you heard me correctly. You're going to have 400 or 500 of these examples. Okay, and when picking a setup, the other thing that you want to strongly consider is the ease of backtesting that setup. So I recommend a 60-minute chart, no less than 2 parameters in your setup and no more than 6 parameters in your setup, and it only involves one chart. That's just to start with. Later on, if you want to get more, technical about it and backtest something more complex, that's fine. But again, you want to master one thing as quickly as possible, and you want to start earning money with it as quickly as possible. Okay, so the simpler the better. Believe me, the simpler the better. Okay, and I do whole sessions on why. And matter of fact, I just did one recently for the mastermind group. But you want to keep it as simple as possible. Okay, so here's our setup. Now, we're going to use, a lot of times, depending on what the indication is, each indication has a wave. And sometimes it completes its wave and sometimes it doesn't, because not every setup works. Not every trade is going to win, right? And that's okay. We don't expect for it to win. Matter of fact, that's why we do this, so we can see at what rate we expect for it to win and what rate we expect for it to lose. But for this particular trade, we're going to use a 6-candle method, which means usually starting from the oversold and moving up, you have 3 to 6 candles before it finishes its cycle. So we're going to look at its whole cycle, or its whole potential cycle, which will be 6 candles. So what we're going to do, let's just say, so we're looking for a buy or a long trade right here. We're going to go 1, 2, 3, 4, 5, 6. We're going to look at 6 candles. Okay. Now, here's what you want to do. From where you would have entered the trade, which would have been at the end of this candle right here, right? And if we're looking for a buy, then we want to see what is the highest point. How much did it go in our favor, right? In this case, the highest point, the buy. How much did it go in our favor out of those 6 candles? Right there, 26.7 pips. And that means that from this point back, that's our draw. Whatever happened, the lowest point it went before our highest point is our drawdown. Okay? So this is how we map this out, right? We first identified the highest point, and then after we identify that, then we look at before that highest point, what was the lowest point? And right here is the lowest point. Let me draw that backwards. So let's go from here to there, and then from here to there. Okay. So right here, it drew down 6.6 pips, and let's just say over an hour, right? So right here, our duration was 60 minutes, because that's how long it took to draw down and come back to break even. And we saw that. It went down to that point and then went back to break even, where the trade would have started. And then we stopped counting right there. So let's just say it's probably less than 60 minutes. Well, let's just say it's 60 minutes. It drew down 6.6 pips over the course of 60 minutes and then came back to break even. So right there, it came back up and is at break even. Okay? And then from that break even point to its peak, which is from here to there, it moved for 3 hours, right? 1, 2, 3 hours. So 180 minutes. Our drawdown, how much it went against us in that 60 minutes is 6.6 pips. Our post-trade movement, how much it went in our favor out of those 6 candles, is 26.7 pips. So 26.7 pips over 3 hours, which in minutes would be 180 minutes. So we'd mark that as minutes, okay? The direction here was long. We'll put 1 for buy, 2 for sell. And then the time was 0100 or 1300, I can't remember. So let's just put 1300. 1 p.m., okay? Now we do this for every single instance that it happens, for the time of day you're trading, for the entry, for the time of day you're trading, on the currency pair you're trading, for the setup you're trading over the course of 5 years, right? After a while, you could probably do one line every 30 seconds. Every 30 seconds. At first, it may take you a couple minutes to do each line. But then after a while, you get really fast at it. And then you're doing it every 30 seconds. And you'll have, with a 60-minute chart over 5 years, you'll have, 500, maybe even 1,000 examples, right? Now, this is not telling us yet what our stop loss and take profit should be. So once it's done, right, then we have all kinds of data here, right, and all these columns. And what we can do is, let's just say that the culmination of that data was this information, okay? Or let's just use something like this. Let's say that after we analyze it, we see that we can get, let's just say 5 pips of profitable movement, right, before it goes, let's just say 5 pips against us. So our data showed us that 80% of the time we can get a 5 pip profit in less than 5 pips of drawdown. 20% of the time we will hit 5 pips of drawdown and lose that trade and not win. 20% of the time. 80% of the time we will hit our profit before we hit our stop loss. But we didn't just decide this. We collected the information and let the information tell us at what win rate, with what risk reward, we can win. And it has to be something that makes profit. So like I said, if you just went back to see if your trade worked, right? And let's just say we said, well, if I did, and I'll just show you an example here. If I did let's just go somewhere random. Let's go back here. So if I did a 10 pip take profit, right, for a buy right here, and 100 pip stop loss, so let's 113.012, so 113.112, 113.112. If I wanted to get to that blue line, 10 pips, before I got down to 112.012, which it did go down to, but let's just 112.012. How often would I win that trade, right? And let's say, so I've got a 100 pip stop loss, and a 10 pip take profit. And let's say I win this trade 90% of the time. We could even say 99%, but let's just use 90. It's a round number. So let's say we win 90% of the time. So 90% of the trades that I put in win. And you would think, wow, you're making a lot of money. No, it's relevant. It depends, right? So let's look at this. If I took 10 trades, okay, if I took 10 trades and I won 9 of them, I won 9 trades for 10 pips, right? Then I won 90 trades or 90 pips. And then I had one loser for 100 pips. I would lose 100, right? And 100 minus 90 is minus 10. So I lost, out of those 10 trades, I lost 10 pips. But I'm winning 90% of my trades. How am I losing money? It's just math. It's not because I said so, it's just math. Right? And what people don't realize is math exists in trading. This math. And people think, oh, I got to be good at math. Look, this is basic stuff. People know this stuff before they're in the 5th grade. Right? You have a calculator, you can figure this stuff out. We have within our membership, and I was actually just showing you the site here a moment ago. We have tools that you don't even have to know how to do the math. You just got to put in your parameters. Account balance. Let's say you have a $2,000 account. Your win rate. Let's say you have a 90% win rate. This is going to tell you you could risk up to 4%. Your stop loss, 100. This is going to tell you your max lot size is 0.08. So it's 80 cents per pip. Okay? And your minimum take profit is 20. So you can't use a 10 pip because your minimum is 20. You have to use 20 or more. You have to try to get 20 or more pips of movement in order to take that trade and it be profitable. Otherwise, it's not going to be profitable. Right? Now, our members, we have a really high level of expectation. We want profitable trades, but we don't want anything below 70% because it's too easy with our indicators to be at 70% or better. So if I put 69 in here, it's going to say NAN, do not trade. If I put 70 in there, then it'll give me an output, 0.01 max lot size, and I need a minimum take profit of 50 if I'm going to win 70% of my trades with a 100 pip stop loss. Minimum take profit of 50. So I need to get 50 or more pips in order for that to be profitable, right? And it even tells you your lot size, that your max lot size that you should use, and the risk that you should use for that win percentage, right? And those are, I mean, you can be a little fluid with that, but this is like the most, this is the safest. Okay, so even if you didn't know how to do the math, obviously we can do it for you. So it's not a big deal. But the point is that if you're not doing the math altogether, then you're shooting in the dark and you're hoping to hit something. Again, you're better off in Vegas, right? At least you'd have fun doing it. At least you'd have fun losing all that money and getting kicked in the teeth. With this, it's not fun when you start losing at that level, right? So you want to be consistent with it. You want to make sure you know what you're doing. You want to collect the information correctly so that at the end of it, you can analyze it, and that analysis will tell you exactly what your stop loss and what your take profit should be, and at what win percentage you can expect to win at that stop loss and take profit. That's what the golden ratio analysis does. There is another way, and we showed you this way before. You can go and watch another video on backtesting where we said you could go back with a predetermined notion in your head. You could say, I think this trade will give me a 10 pip profit before a 10 pip drawdown. Before I hit a 10 pip stop loss, I can get 10 pips of profit. And you go back and you test it and you realize, well, I can only win that 50% of the time. Well, that's not going to work, right? You would think, well, you would break even, but you wouldn't. Because if you won 50% of your trades for 10 pips and you lost 50% of your trades for 10 pips, then you would have zero, right? You would break even, but you wouldn't because you have commissions and spread and swaps and things like that can happen. Commissions always happen every time you push the button. So even just that, if you took 10 trades and they were just at a 1.0 lot, each of those trades for some brokers could be as little as like $2. So you took 10 trades for $2 each, which is $20, right? So you actually lost $20. You didn't lose any pips, but you lost $20. Even if you didn't lose any pips and you didn't lose any dollars, you don't want to trade to make nothing. You want to trade to make something, right? So there are certain risk rewards and win percentages that work, and there are others that don't work. So let me show you another example here of how we would collect this information. I want to show you a very specific example. So let's just go to a clean chart. And I'm going to look for this. Let's see. Let's use let's look at this one. Okay. So let's say that this is our setup, right? Whatever the indicators look at like right there, let's say that was our setup, and we're going to take a sell trade, or we're hoping it's going to be a sell trade, and we're back testing it. So we go 6 candles, 1, 2, 3, 4, 5, 6. Now right here, the most we went in profit was right there, 3 pips. So from right there to there, 3 pips. So what happened before that 3 pips? Well, there's a couple ways to look at that. We could go to a smaller chart and look at it, 5 minutes at a time, or even a 1-minute chart. So let's go here. And let's look at 5 minutes at a time. So these are both the same place. This is the last 5 minutes of that candle, of that 60-minute candle. It takes 12 of these candles to make one of these candles. So if I click forward on this chart, then I'm going to see the first 5 minutes of the next candle. Okay, so let's do that. I'm going to clean this chart up. Okay, so let's see how long did it take us to go 3 pips? Right there, 3 pips. So that's how much we went in profit, and our drawdown is like 0. So how do we collect that? Well, we just put it right here. Duration, 0, because it didn't draw down. Drawdown, 0, because it didn't draw down. Post-trade movement, 3 pips. And post-trade movement duration, 5 minutes. That's how we would collect that. And then right here, we might make a note, right? Because in those 6 candles, it went 1, 2, 3, 4, 5, 6. It went 37.6 pips. So right here we could put after profit, market moved 38 pips negative. So when we're going through our data and we're like, well, this really didn't move very much, we can say, oh, it's because after it moved that 3 pips, that's all it went in our favor, and then after that it will move 38 pips against us. So then we say, okay, then either way that would have been a loser. But if we collected a whole bunch of information that looked like this, then we would know we could get a really quick scalp before any drawdown or anything else happens, right? So we collect it just like it is, because that's very useful information. The other thing we can do with this data is we could look at, is there anything in duration that sticks out, right? What if 90% of the time our trades go against us for 10 minutes? Well, guess what we're doing? We're not going to execute until 10 minutes is up. So we see our setup, the candle posts, we're supposed to enter right then, but the data says wait 10 minutes. Because you draw down for about 10 minutes and then you come back and you start moving into profit. So then we just wait 10 minutes and then we execute. Or it says that your winning trades or your trades that do go into profit, you can win within 30 minutes. But if you wait, if you're in that trade for more than an hour, you lose 20% likelihood that it's going to win. And then after, let's just say, an hour and 20 minutes, you lose 70%. So then the other thing you could do is you could say, okay, I'm going to wait 10 minutes and then I'm going to enter the trade. But from when I enter to an hour, I'm not going to hold on to that trade for more than an hour. Or if I get to the 120-hour and 20-minute mark, I'm not going to wait anything beyond that. I'm going to close the trade. So that trade will either close with a small profit or maybe a small loss, but obviously you haven't hit your stop loss or take profit yet. But you're using the data to tell you how to do that. You're not just guessing, and you're not using whatever your perception might be. You're using the data. You're using a scientific and mathematical approach to determine what decisions you make based on your trade plan. So once you have your trade plan, then you have your win percentage, and you have a risk to reward that makes profit within that win percentage, and the best risk to reward that makes profit within that win percentage. What's your risk to reward, your stop loss, and take profit, right? And then based on that information, you can determine what your risk percentage should be. And there's a formula for this as well. And again, the way we realized this was we see that just with any other type of data, there is mathematical probability and mathematical improbability. Now, if I'm winning 70% of my trades, then mathematically I know that it is probable that I will hit 5 back-to-back losers at some point. Right? I know that I will hit 5 back-to-back losers. It's not if, but when. Now 6 is a much smaller probability, and 7 is almost a mathematical improbability if you're winning 70% of your trades, right? So using that number, what is the tail end of the probability scale, we could say at some point we're going to hit 5 back-to-back losers. Now, if we don't ever want to lose more than, say, 15% of our account, I recommend 10, but let's just say 15% of our account, then on every trade, we're going to assume that could be the first of 5 losers. So we're going to set our risk percentage accordingly. So if I risked 2% per trade and I lost 5 back-to-back losers, I would actually be just under 10%. You would think, well, 5 losers at 2%, 2% 5 times is 10%. Yes, but if I traded and I lost the trade, then my account balance is 2% less. So if I started at 2,000, right, and then I lost 2%, then I would be at 1,980, right? And then I risked 2% of that, right? And then I would be less, and then 2% of that, and so on. So after I did 5 trades and lost 5 trades, I would be just under 10% loss of my whole account from where I started, 2,000. But I would not be at 15%. And I know that even though I know I'm going to hit 5 back-to-back losers, that I'm going to dig out of that, and a lot of times I'm going to hit a streak of winners. And I'm going to make profit out of this, even in spite of the losers, in spite of the back-to-back losers. I'm going to make profit, so I stick to the plan. And it helps to know what to expect. So when it happens, you expected it. It doesn't catch you by surprise. And if it doesn't catch you by surprise, then you don't do irrational, illogical, emotionally driven things that could cause for you to continue to lose money in the market. So again, those psychological facets that could otherwise destroy a day trader can be very well offset by just having a very solid, structured plan and then sticking to it. Because believe me, and we talked about this last week, it's difficult to stick to the plan when you have back-to-back losers. Right? Last week we saw that we had that streak of 4 back-to-back losers within that sequence. We were kind of driving the point home based on those 4 back-to-back losers, that it's difficult to push the button and enter another trade after you've had 2 back-to-back losers. And then you have another loser. Now you've got 3. It's even harder to push the 4th time and get into that trade, but that's what you have to do. And then you have 4 back-to-back losers. By the time you get to that 5th trade, knowing that you could very well have a 5th trade that loses, it's hard to pull the trigger. But you have to do it. You have to do it. That is the markings of a professional day trader. Doing the things that made you uncomfortable. Right? Because after a while you get callous to them. They don't make you as uncomfortable anymore. They don't throw you off your game anymore. But initially, they are going to throw you off your game. They are going to make you uncomfortable. They're going to make you become emotional and want to do things that don't make sense logically. And it's going to cause for you to lose trades and revenge trade or do stupid things that you shouldn't be doing. So we're going to pick this up next week, and we're going to talk about some of the other facets of this so that I can tie this all in together for you. But you can see why we have these specific things within our backtesting process, because they're so imperative. We need these things to have a representative sampling. Now, again, we have, and I was showing you on that site, actually I wasn't showing it to you, but I can show you. We have backtest data that we provide to our members, to our subscribers. And you could use that data, and there's a specific way to use it. So we've done a lot of the legwork for you. But believe me, doing it for yourself opens up a whole new realm of understanding and knowledge and wisdom that you would never have been able to acquire otherwise. Okay, as usual, I want to end with our offer. So if you guys see value in what we're doing here, you guys like what we're doing, you guys want to try it out, you guys want to see if it's something that fits you, right? This is your opportunity. $10 and you get to try it out. You're going to get access to our indicators, the indicators you were just looking at, on-demand training videos, weekly continuing education webinars, and daily trading webinars where coaches will take trades with you in the market, and you can mimic those trades if you like, and just to see how other coaches analyze the indicators, be able to glean from some of that education as well. Real-time trader chat for mobile and desktop, the alerts, of course, and then you're going to get 2 sessions, one-on-one with a professional day trader. The $10 that you sign up for this, 100% of that goes to Feeding America, and they are feeding people across this country, people that are in need, your neighbors, people that, in places where, in the U.S. where, maybe they're having a really hard time, whatever it might be. But believe it or not, $10 creates 100 meals. So your $10 would create 100 meals for people in need. So that's great, even for that on that. But do it to see if it's something that you can really use to change your financial trajectory. All right? You go through that process. We vet each other. We see if you're a good fit for us, and if we're good, and you get to see if we're a good fit for you. And then we talk about what the next steps are, which is our coaching programs. So let's do that. Let's have that conversation. Let's get into the Trader Light. Those of you guys that have already joined the Trader Light, awesome. We've had an awesome time working with you guys. Congratulations to those of you guys that are moving on to trading our corporate funds and changing your financial trajectory. We've got a bright future in store for you. And for those of you guys that have not, take the leap. Do it. Try it out. It's only $10. Go to daytradesmart.com/free. It's not free. Not anymore. We were doing it for free for a while. It's just $10 now. Get signed up today. You're going to get immediate access to video content. You're going to be able to register for webinars. You're going to get immediate access to the indicators. That obviously the market's not open until Sunday, but on Sunday at 5 o'clock Eastern, those you're going to see them moving. You're going to be able to play around with them. You're going to watch videos that'll teach you how to use them, so on and so forth. It's a ton of stuff. Get signed up for the Trader Light program. Give us an opportunity to work with you and see if we have a good fit, and we'll go from there. As always, thank you guys for joining us for the sweep, and we'll look forward to talking with you next week. Have a good